On the night of November 22nd, 1910, under a moonless sky, a private rail car sat waiting on an empty platform at the Hoboken Terminal in New Jersey. The blinds were drawn, the lights were low, and one by one, six of the most powerful men in the United States slipped through the darkness, boarded that car, and vanished into the night. They told no one where they were going. They used only first names. One of them had never fired a shotgun in his life, but he carried one anyway because the cover story was that they were headed south for a duck hunt. They were not going hunting. They were going to draft the blueprints for a financial system that would reshape the United States and arguably the entire world for the next century and beyond. This is the story of how the Federal Reserve was born, not in the halls of Congress, not in a public debate, not with the knowledge or consent of the American people, but in secret on a private island off the coast of Georgia, behind locked doors, by a handful of men who collectively represented an estimated 1/4 of the total wealth on the planet. And the most remarkable part of all, they managed to keep it a secret for over 20 years. To understand why these men were on that train, you have to understand what America looked like financially in the years leading up to 1910. Because the truth is, the United States was an economic powerhouse with a fatal weakness. It had no central bank, and that weakness kept detonating over and over again with catastrophic results. Between 1863 and 1910, the country experienced at least three devastating nationwide banking panics and as many as eight more localized crises, depending on which economic historian you ask. These weren't minor corrections. These were full-blown collapses where banks shuttered their doors, businesses crumbled, and entire communities were financially wiped out overnight. The panics of 1873, 1893, and 1907 were the worst of them, each one more destructive than the last, each one exposing the same structural flaw in the American financial system. There was no mechanism to inject cash into the economy when it seized up, no lender of last resort, no safety valve. The worst of these crises, and the one that ultimately set the stage for everything that happened on Jekyll Island, was the Panic of 1907. It was the first worldwide financial crisis of the 20th century, and it transformed what had been a modest recession into a contraction surpassed in severity only by the Great Depression itself. In October of that year, the New York Stock Exchange plunged nearly 50% from its peak the previous year. It began with a failed attempt by a speculator named F. Augustus Heinze and his associate Charles Morse to corner the copper market. Heinze was the president of the Mercantile National Bank, and Morse controlled the National Bank of North America. When their copper scheme collapsed, the banks connected to them started hemorrhaging deposits. Panic spread like wildfire. Depositors lined up around the block, desperate to pull their savings out before the banks ran dry. Trust companies, which were essentially unregulated shadow banks of that era, holding enormous sums but operating outside the clearinghouse system that protected national banks, began toppling one after another. The Knickerbocker Trust Company, the third largest trust in New York City, was one of the first to fall. On Friday, October 18th, news broke that its president, Charles Barney, was connected to Heinze's copper scheme. Depositors panicked. By Monday, October 21st, the National Bank of Commerce announced it would no longer clear checks for Knickerbocker. That single decision was a death sentence. Within hours, thousands of depositors swarmed Knickerbocker's offices, demanding their money back. The trust company slammed its doors shut, leaving families stranded without access to their life savings. And then the contagion spread to other trusts, to other banks, to other cities. Credit evaporated. Businesses couldn't get loans. Workers were laid off. The stock exchange nearly ground to a halt because there was simply no money available for brokers to execute trades. The entire financial system of the most powerful industrial nation on earth was on the verge of imploding. And in the absence of a central bank, in the absence of any government mechanism to inject liquidity into the system or act as a lender of last resort, the fate of the American economy fell into the hands of one man. His name was John Pierpont Morgan. At 70 years old, J.P. Morgan was the undisputed titan of American finance. He controlled an empire of banks, railroads, and steel companies. He had personally funded Thomas Edison's quest to electrify the nation. He controlled nearly half the country's railroad mileage. And when the panic of 1907 reached its most terrifying crescendo, Morgan did something extraordinary. He summoned the most powerful bankers in New York City to his private library on Madison Avenue, a brownstone at the corner of 36th Street. He ordered them to open their books. He locked the doors and he refused to let anyone leave until they had pledged millions of dollars of their own money to stabilize the banking system. Morgan personally pledged enormous sums, convinced other financiers to do the same, and even enlisted the Secretary of the Treasury, George Cortelyou, to deposit $25 million of federal funds into New York's national banks. Between October 21st and October 31st, the Treasury deposited a total of $37.6 million into the banking system and provided $36 million in small bills to meet the runs on deposits. John D. Rockefeller chipped in another $10 million to support the struggling trust companies. Together, through sheer force of personal wealth and iron-fisted negotiation, they managed to stop the bleeding, but only barely. Morgan even orchestrated a takeover of the Tennessee Coal, Iron, and Railroad Company by his own U.S. Steel Corporation, a move that required the personal approval of President Theodore Roosevelt to prevent the collapse of a major brokerage firm whose loans were backed by the company's plummeting stock. It was financial triage on a scale the country had never seen. The panic of 1907 was eventually contained, but it left behind something far more dangerous than the financial wreckage itself. It left behind a question that no one could ignore any longer. What happens next time? What happens when the crisis is too big for even J.P. Morgan to handle? What happens when Morgan is dead? Because everyone understood the terrifying implication. The financial security of nearly 90 million Americans had just rested on the personal judgment and willingness of a handful of private citizens. Not on a government institution, not on a public system, on the mood and the ambition and the bank accounts of a few very rich men. As one New York banker put it, if the next panic were any bigger, their banks would not collectively have enough assets to stop it. The public was outraged, newspapers demanded reform, and Congress, under mounting pressure, passed the Aldrich-Vreeland Act on May 30th, 1908, which did two things. First, it created an emergency currency mechanism, a temporary patch to prevent total collapse in the event of another panic. And second, and far more importantly, it established the National Monetary Commission, a body of 16 members, 8 senators, and 8 representatives, charged with studying the causes of financial crises and recommending a permanent solution to the nation's banking instability. The man chosen to lead this commission was Senator Nelson Aldrich of Rhode Island. Now, to understand the significance of that choice, you need to understand who Nelson Aldrich really was, because his story tells you everything about the forces that converged on Jekyll Island. On paper, he was one of the most powerful Republican senators of his era. President Theodore Roosevelt himself called Aldrich the kingpin of the Republican Party. He chaired the Senate Finance Committee. He was the majority leader in all but name. Journalists described him as one of the Senate Four, a small group of Republican senators who essentially controlled the institution for a decade. When Aldrich spoke, the Senate listened, and when he made deals, the country felt the effects. But behind the public title was a much more revealing private reality. Nelson Aldrich was deeply, inextricably connected to the most powerful financial interests in the country. His personal fortune had grown from roughly $50,000 when he first entered politics to at least $12 million by the time he was leading the Monetary Commission. Lincoln Steffens, the great muckraking journalist, wrote a devastating profile of Aldrich in 1905, calling him the boss of the United States. David Graham Phillips devoted an entire chapter to Aldrich in his infamous series for Cosmopolitan magazine, titled The Treason of the Senate, describing Aldrich as the head of it all, representing a single interest with a single purpose, getting rich at the expense of the labor and the independence of the American people. And then there was the family connection that made everything else look subtle by comparison. Aldrich's daughter Abigail had married John D. Rockefeller Jr., the only son of the Standard Oil founder and the wealthiest man in America. That single marriage bound one of the most powerful political figures in the country to the wealthiest family on earth. The Aldrich-Rockefeller alliance was not hidden. It was widely known, widely discussed, and widely feared. And it meant that whatever banking reform Aldrich proposed would inevitably carry the fingerprints of the very people who stood to benefit the most. For 2 years, the National Monetary Commission conducted an extensive study of the problem. Aldrich personally led a delegation across Europe visiting London, Paris, and Berlin, examining how the great central banks of the Old World operated, the Bank of England, the Banque de France, and the Reichsbank of Germany. He spent roughly $300,000 of public money on these fact-finding tours, a staggering sum at the time. He came back deeply impressed by what he had seen. He became convinced that the United States needed a central banking system modeled on the European approach, with the ability to manage the money supply, set interest rates, and provide emergency liquidity. But he had not yet put any of it down on paper. The commission issued some 30 reports, but Aldrich himself had not produced a concrete plan. By the fall of 1910, Aldrich was running out of time. Congress was about to reconvene in just a few weeks. He needed a concrete proposal, a draft bill that he could present. And this is where the story takes its most dramatic turn, because Aldrich knew that he could not write this bill alone. He needed the expertise of the country's top financial minds, men who understood not just monetary theory, but the day-to-day mechanics of how money moved through the banking system. But he also knew something else, something politically lethal. If the public discovered that Wall Street bankers had drafted the nation's new banking legislation, the bill would be dead on arrival. Americans harbored a deep, almost visceral distrust of centralized financial power. The idea that the so-called money trust would design the rules of the game for everyone else was politically toxic. No congressman would even consider a bill with the scent of Wall Street on it. So, Aldrich decided to do it in secret. The plan was most likely suggested by Henry Davison, a senior partner at J.P. Morgan and Company, and one of the most influential bankers on Wall Street. Davison had risen from an office boy at a small bank in Connecticut to the inner circle of the Morgan Empire by sheer force of competence and ambition. By the age of 35, he was vice president of the First National Bank of New York. In 1903, he founded the Bankers Trust Company, which quickly became the second largest trust company in the country. 5 years later, J. Pierpont Morgan personally asked Davison to become a partner at the House of Morgan. He understood better than anyone that the bill needed to be technically sound. He also understood that it needed to be politically invisible. Aldrich handpicked the attendees with surgical precision. Each one represented a critical pillar of the financial establishment, but none could be seen in public together without raising alarm. There was Frank Vanderlip, the president of National City Bank of New York, which was the most powerful bank in the country at the time. Vanderlip represented the investment interests of the Rockefeller dynasty and the international banking house of Kuhn, Loeb and Company. His life story was the kind of up-from-nothing narrative that Americans usually celebrated. He had grown up on a farm outside Aurora, Illinois, and as a teenager took a job in a machine shop to support his family after his father died. He later became a financial journalist at the Chicago Tribune, caught the eye of Treasury Secretary Lyman Gage, and eventually rose through government and banking circles to become one of the most influential financiers in the country. Despite his populist background, he was now firmly embedded in the Rockefeller orbit, and his bank, National City, was one of the main repositories for Standard Oil's enormous cash reserves. There was Paul Warburg, a German-born banker who had immigrated to the United States in 1902 and become a partner at Kuhn, Loeb and Company. Warburg was arguably the most technically brilliant member of the group. Born in 1868 into the Warburg banking dynasty of Hamburg, his family had been in finance since the 1500s. His great-grandfather had founded M. Warburg and Company, one of the oldest and most prestigious banking houses in Europe. Paul had trained in London and Paris before coming to America, where he married Nina Loeb, the daughter of Solomon Loeb, co-founder of Kuhn, Loeb and Company. He understood the mechanics of central banking intimately because he had grown up inside it, and he had been publicly campaigning for years, writing essays and giving speeches, arguing that America desperately needed a central banking institution. After the Panic of 1907, he published a landmark essay titled Defects and Needs of Our Banking System, which diagnosed the structural vulnerabilities with devastating clarity. He was, in every sense, the intellectual architect of what would become the Federal Reserve. There was Abraham Piatt Andrew, the Assistant Secretary of the Treasury, who also served as the Special Assistant and Research Director of the National Monetary Commission. Andrew was an academic turned government official, a man with deep knowledge of monetary theory and connections to both the Morgan and Rockefeller camps. There was Arthur Shelton, Aldrich's private secretary, who handled logistics and kept the paperwork moving. And there was Henry Davison himself, the Morgan partner, who had likely conceived the idea of holding the meeting in the first place. Some accounts also place Benjamin Strong at the meeting. Strong was the vice president of Bankers Trust Company, a Morgan-controlled institution, and he would later become the founding governor of the Federal Reserve Bank of New York, which would become the most powerful branch in the entire system. Frank Vanderlip later recalled Strong's presence in his autobiography, but no other first-hand account confirms he was there. Most scholars consider his attendance uncertain, though his later role in the Federal Reserve makes his potential presence all the more significant. These were the men who boarded Senator Aldrich's private rail car on that November night. Together, they represented the three most dominant financial power centers in the Western world: the Morgan banking empire, the Rockefeller financial dynasty, and the Warburg-Kuhn Loeb axis connecting European and American investment banking. It has been estimated that collectively, these men controlled or represented roughly 1/4 of the entire world's wealth, and they were about to write the rules for how America's money would work. The precautions they took to keep the meeting secret were extraordinary, almost cinematic in their paranoia. Aldrich instructed each man to arrive at the Hoboken terminal separately, one at a time, to avoid being seen together. They were told not to dine together the evening before their departure. They used only first names once aboard: Nelson, Harry, Frank, Paul, Piat, and Arthur, so that the staff aboard the train and at their destination could not identify them. For decades afterward, the group referred to themselves as the First Name Club, a tongue-in-cheek name for what was essentially a clandestine operation conducted by some of the most recognizable men in the country. Paul Warburg, who had never held a shotgun in his life, brought along all the trappings of a duck hunter to make the cover story believable. He later admitted this with some amusement, acknowledging that any reporter who had seen him trying to handle the borrowed weapon would have immediately known the whole thing was a sham. Piat Andrew didn't even tell his boss, the Secretary of the Treasury, where he was going. The private car carried them south through the night along the eastern seaboard toward the coast of Georgia. Their destination was Jekyll Island, a barrier island accessible only by boat, roughly a mile off the mainland near Brunswick, Georgia. It was home to one of the most exclusive private clubs in the world. The Jekyll Island Club had been founded in 1886, and its membership roster read like a directory of the American ruling class. J.P. Morgan himself was a co-owner of the club. Other members included Marshall Field, the Chicago retail magnate William Kissam Vanderbilt I, heir to one of the great railroad fortunes, and Joseph Pulitzer, the newspaper titan. Munsey's magazine had described the club in 1904 as the richest, the most exclusive, and the most inaccessible club in the world. The mansions that dotted the island were called cottages, a characteristically understated name for what were essentially palaces surrounded by moss-draped live oaks, salt marshes, and the sound of the Atlantic. It was the perfect place to disappear. When the group arrived, the club's regular staff had been given 2 weeks of vacation. New servants brought in from the mainland replaced them. These replacements had no idea who the guests were and could not have identified them even if they had been interrogated afterward. The club's kitchen prepared meals. The marshes and dunes provided isolation. The men settled into the clubhouse, and on or around Thanksgiving Day, November 24, 1910, they enjoyed a dinner of wild turkey with oyster stuffing. And then they got to work. For roughly 9 days, from late November through early December of 1910, these men worked from morning until deep into the night, hammering out the details of a new banking system for the United States. They debated, argued, wrote, revised, and rewrote. Paul Warburg, as the most technically proficient among them, did the bulk of the actual drafting. Senator Aldrich focused on ensuring the plan could survive the political gauntlet of Congress, tweaking language and structure to make it palatable to lawmakers. The bankers contributed the practical knowledge of how money actually moved through the system, where the pressure points were, what mechanisms would give the economy the flexibility and stability it needed, and it must be said, what structures would best serve the interests of the institutions they represented. The single most contentious debate at Jekyll Island was not about economics, it was about politics. Specifically, it was about optics. Aldrich, drawing from his tours of European central banks, initially pushed for a straightforward central bank, a single institution modeled on the Bank of England or the German Reichsbank. One bank with centralized authority over the money supply, simple, clean, efficient. But Warburg and the other bankers immediately recognized the political impossibility of that approach. Americans had a deep historical distrust of a centralized financial power. The ghosts of Alexander Hamilton's First Bank of the United States and Andrew Jackson's brutal war against the Second Bank of the United States still haunted the national consciousness. The very phrase central bank was political poison. Any proposal that looked like a single, all-powerful institution controlled by Wall Street would be dead before it ever reached the Senate floor. Aldrich resisted. He saw the European model as superior and wanted to replicate it faithfully. But Warburg pushed back, and the other bankers sided with him. Political realities demanded a different approach. Warburg proposed what he and others would later candidly describe as a concession to political necessity, but which critics would call a deliberate disguise. Instead of one central bank, they would propose a system of regional reserve banks scattered across the country, each ostensibly independent and responsive to local economic conditions. The system would give the appearance of decentralization, of democratic control spread across the continent. But in reality, through mechanisms of coordination, reserve requirements, and the structure of a governing body, the system would function as a unified central bank. The power would be centralized. It would just be hidden beneath layers of institutional architecture designed to make it look otherwise. Whether this was prudent governance or deliberate deception depends entirely on your perspective. Warburg himself seemed to view it as both, the necessary price of political survival. Aldrich eventually gave in. The regional structure prevailed. By the time they left Jekyll Island, the men had produced a detailed draft that would become known as the Aldrich Plan. It proposed a National Reserve Association, which would consist of 15 regional branches located in major cities across the country, each governed by directors chosen from the member banks in that district. The association would hold the reserves of the banking system, have the power to issue a new elastic currency backed by commercial paper and gold, set discount rates to influence borrowing costs, and act as a lender of last resort during financial crises. It was, in its essential design, a central bank wearing the clothing of a federation. The group returned north as quietly as they had departed, and then they waited. Senator Aldrich presented the plan to Congress in January of 1911. He first tested it in a closed-door conference with 23 leading bankers in Atlantic City, lining up support from the financial establishment. By November of 1911, the full American Bankers Association had endorsed the plan. The threat of resistance from smaller banks had been managed. But in the public arena, the Aldrich Plan ran into a wall of opposition almost immediately. The problem was not just the substance of the plan, it was the suspicion. Even though the Jekyll Island meeting remained a closely guarded secret, the plan carried Aldrich's name, and Aldrich's name carried all the baggage of his connections to Wall Street and the Rockefeller family. Progressives in both parties attacked the proposal as a naked power grab by the money trust. Congressman Charles Lindbergh Sr., father of the famous aviator, was among the most vocal critics, pointing out that the University of Chicago, which was enthusiastically promoting the Aldrich Plan through academic propaganda, had been endowed by John D. Rockefeller with nearly $50 million. The implication was clear. The intellectual case for the plan was being bankrolled by the very interests that stood to profit from it. Meanwhile, a separate congressional investigation, the Pujo Committee hearings, chaired by Representative Arsène Pujo of Louisiana, was already underway. Running from May 1912 through January 1913, these hearings examined the concentration of financial power in the hands of a few interconnected banking dynasties. The evidence was damning. Interlocking directorates tied Morgan, Rockefeller, and Kuhn, Loeb interests together in a web of overlapping control that extended across banks, railroads, insurance companies, and industrial firms. The committee's findings confirmed the public's worst fears about the money trust. The timing could not have been worse for Aldrich. His plan stalled in Congress, and then, in the elections of 1912, the political landscape shifted dramatically. The Democrats swept into power. Woodrow Wilson won the presidency. Democrats took control of both the House and the Senate. The Democratic platform explicitly opposed the Aldrich Plan, condemning what it called the domination of the money trust, and calling for a systematic revision of banking laws that would protect the public from concentrated financial power. Aldrich himself chose not to seek re-election. The Aldrich Plan as a political vehicle was finished. But its ideas were not even close. Here is where the story becomes truly fascinating, because even though the Aldrich Plan was officially dead and buried, its ghost lived on, almost line for line, in the legislation that replaced it. Congressman Carter Glass of Virginia, the new chairman of the House Banking and Currency Committee, was tasked with drafting alternative legislation. Glass enlisted the help of Henry Parker Willis, an economics professor at Washington and Lee University, who also wrote for the New York Journal of Commerce. Together, they crafted what would become the Glass-Owen Bill, the precursor to the Federal Reserve Act. Glass publicly positioned his bill as a fundamental repudiation of the Aldrich Plan. He emphasized the differences. His version would have regional banks, yes, but oversight would come from a Federal Reserve Board composed entirely of presidential appointees, not bankers. The government, not Wall Street, would hold the reins. There would also be a Federal Advisory Council of 12 bankers who could meet periodically with the board, but they would have no binding authority. It was presented as a progressive reform, a populist correction to the excesses of the Aldrich era. Wilson insisted that Federal Reserve notes be obligations of the government, a concession that won over William Jennings Bryan in the populist wing of the Democratic Party. But here's the critical detail that Warburg and the other Jekyll Island participants would later make painstakingly clear. The Glass-Owen Bill and the Aldrich Plan were, in their essential architecture, remarkably similar. The regional bank structure, the discount mechanism for commercial paper, the elastic currency provisions, the lender of last resort function, the centralized coordination beneath the decentralized appearance. All of these core elements survived the transition from one bill to the other, virtually intact. Paul Warburg later published a meticulous line-by-line comparison of the two plans, demonstrating how closely the final Federal Reserve Act mirrored what had been drafted in that clubhouse on Jekyll Island 3 years earlier. A lot of it was word for word, as the Federal Reserve's own historian has noted. They just put a different political structure in place. As the prominent A. Barton Hepburn declared at the annual meeting of the American Bankers Association in late August of 1913, the measure recognizes and adopts the principles of a central bank. Indeed, if it works out as the sponsors of the law hope, it will make all incorporated banks together joint owners of a central dominating power. President Wilson pushed hard for the bill, making it a centerpiece of his New Freedom domestic agenda. The House passed its version in September of 1913. The Senate debated through the fall, with every Republican voting for a substitute measure and Democrats closing ranks behind the leadership. On December 22, 1913, the House approved the conference report by a vote of 298 to 60. The Senate followed the next day, December 23, with a vote of 43 to 25. 27 senators were paired or chose not to vote. Many members of Congress had already departed for the Christmas holiday. At 6:00 that evening, President Woodrow Wilson signed the Federal Reserve Act into law. He used 4 pens and gave one to each of the bill's leading sponsors. The Democratic whip, Senator J. Hamilton Lewis of Illinois, quipped that the bill itself had been made in installments. Wilson smiled and agreed, adding, "Yes, and very slowly." The Federal Reserve System became operational in November of 1914. It consisted of 12 regional Federal Reserve banks, a board of governors appointed by the president, and the Federal Advisory Council. The system could issue a new form of currency, Federal Reserve notes, manage bank reserves, and provide emergency liquidity to prevent the kind of devastating panics that had plagued the country for half a century. But who actually owned this new system? The 12 regional Federal Reserve banks were technically owned by the member banks in each district, which were required to purchase stock. The largest shareholders of the Federal Reserve Bank of New York, which would quickly become the most powerful branch in the system, were the same institutions whose representatives had gathered at Jekyll Island. National City Bank, the Rockefeller-connected institution where Vanderlip had served as president, became one of the largest stockholders. The National Bank of Commerce, closely tied to the Morgan interests, took another enormous block of shares. The fingerprints of Jekyll Island were everywhere, embedded in the very ownership structure of the institution itself. The true nature of the Jekyll Island meeting remained hidden for years. In 1917, the journalist B.C. Forbes, who would later find Forbes magazine, somehow learned about the secret trip and mentioned it in his book, Men Who Are Making America, a collection of short biographies of prominent financiers. But almost no one noticed. Those who did dismissed it as, in the words of Aldrich's biographer, a mere yarn. The participants themselves flatly denied the meeting had ever taken place. Senator Aldrich had pledged them all to secrecy, and for 2 full decades that pledge held. It was not until the early 1930s that the truth finally came out. The catalyst was a memoir published by Carter Glass in 1927 titled An Adventure in Constructive Finance, in which Glass, now a senator himself, claimed sole credit for the ideas behind the Federal Reserve. This infuriated the Jekyll Island participants, who felt their contributions were being erased from history. Paul Warburg published a massive 2-volume work in 1930, laying out his role in the creation of the Fed and making the detailed comparison between the Aldrich plan and the final act that proved their fundamental similarity. He wrote that he'd been impelled to lay down in black and white his recollections after reading Glass's self-congratulatory articles. He carefully avoided mentioning Jekyll Island by name, but alluded to a secret conference with Aldrich in November of 1910. And in a footnote, he added that even though 18 years had passed, he did not feel free to give a full description of the conference because Aldrich had pledged all participants to secrecy. Frank Vanderlip was less restrained. In a remarkable article published in the Saturday Evening Post on February 9, 1935, he wrote openly about the meeting for the first time. He described himself as having been near the close of 1910, as secretive and as furtive as any conspirator. He said he did not think it was any exaggeration to speak of their secret expedition to Jekyll Island as the occasion of the actual conception of what eventually became the Federal Reserve System. He described the elaborate precautions, the first name-only rule, the separate arrivals, the drawn blinds on the rail car. He explained that since it would have been fatal to Aldrich's plan to have it known that he was calling on anybody from Wall Street to help him prepare his bill, extraordinary precautions were taken. And then he added one crucial omission. If what they had done had been made public at the time, the effort would have been denounced as a piece of Wall Street chicanery. That single sentence captures the paradox at the heart of this entire story. The men themselves believed they were doing patriotic work, solving a genuine problem that had caused immense suffering. They may well have been right about the economics, but they also knew with absolute certainty that the American public would never have accepted the solution if they knew who had designed it. The secrecy was not incidental. It was the precondition for the plan's survival, and that raises the question that historians, economists, and ordinary citizens have been wrestling with for over a century. Were these men patriots or plutocrats? Were they solving a genuine problem, that of a dangerously unstable banking system that kept destroying lives? Or were they building a machine designed to protect and enrich the specific financial empires they represented? The honest answer is almost certainly both. The tension between those two realities is what makes the creation of the Federal Reserve one of the most significant and controversial events in modern financial history. The defenders of the Jekyll Island meeting, and there are many including mainstream historians and Federal Reserve officials themselves, argue that the secrecy was a necessary political calculation. The United States genuinely needed a central banking mechanism. The recurring panics of the 19th century had caused enormous human suffering, destroyed businesses, wiped out savings, and thrown millions into unemployment. The men at Jekyll Island had the technical expertise to design a workable system, and they knew correctly that if the public discovered Wall Street bankers had written the legislation, it would never pass, regardless of how sound the economics were. The secrecy, in this view, was not corruption. It was pragmatism in the service of the greater good. The critics, however, see it differently, and their arguments carry weight. They point out that the men who designed the system were not neutral experts. They were representatives of specific financial empires: Morgan, Rockefeller, Warburg, and Kuhn, Loeb, who had direct, enormous personal interests in how the new system would operate. They designed the rules of the game, and they designed them in ways that channeled power and profit toward the very institutions they controlled. The regional bank structure gave the appearance of decentralization while concentrating real authority in New York. The discount mechanism and reserve requirements were structured to benefit large banks over small ones. The ownership structure of the regional banks placed stock directly in the hands of the member banks, meaning the institutions being regulated were also, in a very real sense, the owners of their own regulator. And the secrecy itself is damning, the critics argue. If the plan was genuinely in the public interest, why did it need to be drafted in hiding? Why did the participants deny the meeting for 20 years? Why the false names, the drawn blinds, the borrowed shotguns? These are not the actions of men who believe they are doing something the public would approve of. These are the actions of men who know they are doing something the public would resist and who have decided to do it anyway without asking. The broader consequences of what was born at Jekyll Island are staggering in their scope and ongoing in their impact. The Federal Reserve has become the single most powerful economic institution in the United States and arguably in the world. It controls the money supply. It sets interest rates through the federal funds rate. It regulates the banking system. It serves as the lender of last resort. Its decisions ripple across global markets within seconds. During the Great Depression, the Fed's policies, or more precisely its failures to act, deepened the worst economic catastrophe in modern history. The decentralized structure that Warburg had designed to satisfy political sensibilities proved disastrous in practice as regional banks pulled in different directions and failed to coordinate an effective response. The Banking Act of 1935 reshaped the system, shifting authority to the Board of Governors in Washington and creating the Federal Open Market Committee, the body that sets monetary policy today. During the 2008 financial crisis, the Fed pumped trillions of dollars into the banking system to prevent a total collapse, bailing out many of the same kinds of institutions, trust companies and shadow banks, whose failure had triggered the panic of 1907 a century earlier. The parallels were not lost on historians. In fact, the Federal Reserve's own researchers have drawn explicit comparisons between the two crises, noting that both started among New York City financial institutions. Both involved runs by depositors, or their modern equivalents, on institutions outside the traditional banking safety net, and both required emergency intervention to prevent systemic collapse. And the family connections that were forged in that era still echo through the corridors of power. Nelson Aldrich's grandson, named Nelson Aldrich Rockefeller after the senator himself, went on to become the 41st Vice President of the United States. Another descendant, J. Rockefeller, served as a United States Senator for decades. The institutions that Vanderlip and Davison represented, National City Bank and J.P. Morgan, evolved into what we now know as Citigroup and J.P. Morgan Chase, two of the largest and most powerful financial institutions on the planet. The Federal Reserve Bank of New York, which Benjamin Strong may or may not have helped conceive at Jekyll Island, and certainly went on to lead as its first governor, remains the most influential of all 12 regional banks, executing the open market operations that shape monetary policy for the entire nation. The Jekyll Island Club itself still stands. It is a hotel now, open to anyone willing to book a room. Tourists walk through the same hallways where Warburg drafted his provisions, and Aldrich paced the floor debating the structure of the reserve system. In the main conference room, a plaque on the wall reads that, "In this room, the Federal Reserve System was conceived." What was once a secret is now a historical landmark. What was once denied is now commemorated. But the deeper questions raised by what happened there have never been fully resolved because they are not really questions about 1910. They are questions about now, about whether the institutions that govern our money supply truly serve the public interest, or whether they serve the interests of the financial elite who designed them, about whether transparency and democratic accountability are compatible with the technical complexity of modern central banking, about who really holds power in a system where markets have replaced monarchs, but where the architects of those markets remain largely invisible to the people whose lives they shape. The creation of the Federal Reserve was not just a banking reform. It was a transfer of power from the chaos of an unregulated market to the ordered control of a private-public hybrid institution designed in secrecy by the very men who stood to benefit most from its existence. It was an act of financial engineering so profound that it redefined the relationship between government, banks, and citizens for generations to come. And it was all set in motion on a cold November night on a train heading south through the darkness, by 6 men who were told to leave their last names at home. The clubhouse on Jekyll Island is quiet now. The salt marshes still stretch out toward the horizon. The live oaks still stand draped in Spanish moss. But the system that was born there, the system that controls the lifeblood of the world's largest economy, is anything but quiet. It is alive, it is enormously powerful, and it is still shaping the world you live in every single day, whether you know it or not. If this story changed the way you look at the financial institutions that govern our world, please subscribe to our channel and like this video. We are uncovering the history they tried to bury. Let's plant the seeds of the future together. The next treasure of history will be revealed soon.